when you have a 401k and you add a cash balance to it, I kind of say you kind of bolt it onto the 401k because they work in conjunction. You're kind of supercharging your retirement because you're not only getting the 70,000 or the 77,500 in the 401k profit sharing plan, but the cash balance plan is a defined benefit plan. This type of defined benefit plan is still employer contributions only, but it kind of has a 401k type feel to it. But it allows people to contribute much more. And I'm talking if somebody's in their 60s, they might be able to contribute 200,000, 250,000 more, and it's all in tax deferred status, similar to a 401k plan. It's a great thing to consider if somebody's making high six, into the seven-figure level income. It is pretty amazing.
Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham. We have Ethan Hutchison and Eric Wymore, who are our partners and co-hosts of the podcast. And today we have a very special guest, which is Casey McCarthy. And Casey's with EIP Corporation. And I'll give you kind of a little background of Metcalf Partners and EIP's relationship over the years. But EIP is a third-party administrator, and Casey's going to go into that here in a minute. But they partner with us, and they have since, I guess it's been about 2013. So I had actually first met Corey Brash, who is the owner of EIP. We were in the same Rotary Club and went out to lunch one day. And, over the years, for doing company 401ks has been something we've done for a long time. It's never been a huge focus of our business, but we have a fair amount of them that we do because we have clients that own businesses and have asked us to do it. And then we've just kind of started out relationships that way as well. But it's been a great relationship, and they've definitely kept us in line and made sure that all of our plans stay compliant. But, Casey, I guess we can just kind of start with, why don't you tell us what a third-party administrator is and what you guys do and how you help companies like ours?
Yeah, you bet. And first of all, thanks for having me on. I'm excited about this. So a third-party administrator is a very kind of a unique role. And what we do is we're kind of one part of the mix of players in a 401k. And I like to explain this by saying we really do two things. We design 401k plans and administer them. And the reason that it's important to have those two components is because a 401k is really a generic term for a lot of different bells and whistles you can have in your retirement plan. There's a lot of different decisions to be made. I help consult to make those decisions with the business owner as well as the advisor, because I kind of say the advisor is the quarterback of the situation. So the advisor is usually sitting side by side with me or on a Zoom together, and we walk through and determine what the business owner wants. Because again, some plans are designed primarily for the business owner to max out what they can put away for themselves. Some are designed to attract and retain the best employees. Most are designed with both in mind. Business owners spend so much of their time and effort building their business that a lot of times they get a little bit of a late start on their retirement saving. And so if they, get to 45, 50, 55 and decide it's time to really ramp that up, 401ks a lot of times get started then, but then it's a benefit to everybody because the employees benefit in that as well. So we are kind of one of the players in a 401k, but we are kind of, in my opinion, I'd say the best place to start if a business owner wants to start a plan.
Yeah. And real quick, just so to differentiate our role versus your role. Yep. Okay. So when we get a new 401k plan, typically what we're doing is, as Metcalf Partners, is we're going to educate the employees. So basically we're going to go over fund selection. We're going to help them pick what funds are in the 401k. We're going to go over fund selection. We're going to educate them about how much money based on how much money they're saving, what that should accumulate to given certain rates of return over the years. And you guys are actually, number one, keeping that plan compliant, yep, right? And making sure that it meets the rules of a 401k plan.
Yep.
And then you're also, to your point, designing it with the business owner to help them maximize the amount of money that they can either save on taxes by making contributions, possibly doing profit sharing, and then also, you know, maybe just saving into the Roth portion of that as well. So you're helping them kind of design it to where it benefits them and their employees in the best way. Correct?
Exactly. Exactly. And to chime in on that, we don't not only do we not help with the fund decisions, we are not legally allowed to do any of that. And you as the advisor that's something you focus on and you're very good at and you're qualified to do. But yes, you also, as the advisor, decide who the TPA is going to be. So you decide if we're the firm to hire, and you decide who the custodian is going to be, which is where the assets go when somebody puts money in the plan or the business puts money in the plan. So yes, that's exactly right. So there's different players in the 401k because of the fact that each role is very specialized in the 401k.
Nice. Casey, we've got a lot of small business owners, and a lot of the times, just to your point, you know, they might be later in life and they've got the business going and now they're ready to start buckling down.
Right.
There's a lot of options that are out there.
Mm-hmm.
You know, there's solo Ks, simple IRAs, SEP IRAs, 401ks, defined contribution, defined benefit plans, you name it. The main one that we kind of discuss with our business owners is the 401k. But we also bring up like a simple IRA or a SEP IRA. Can you kind of differentiate the two for us and just why you'd pick one over the other?
Absolutely. So let me start with a SEP. A SEP is a simplified employee pension plan, and that's usually a great option for somebody who's a sole proprietor individual who wants to put away some money, more than an IRA or a Roth IRA. A simple is, now you guys deal with SEPs and simples more than I do, so because they don't need to be administered like a 401k does, and we don't do those. But a simple kind of adds that salary deferral component where an employee can put in their own money as well. But where a 401k happens is the most basic thing is if the business has more than 100 employees, you can't have a simple, so it's not even an option. But we play in the space of under 100 employees all the way down to one, and the 401k, the first thing is you can put a lot more into a 401k than you can in a simple. A simple, you're limited to the $16,000 if a salary deferral if you're under 50, and it's $19,500 if you're 50 or older, or if you're 50 or older, correct. That's for 2025. And then the employer can either do a dollar for dollar match up to 3%, or they can do a 2% non-elective contribution is what we call it, but where they give 2% to everybody in the business. Whereas a 401k has much higher contribution limits. And do you want me to mention those real quick?
Sure. Yeah, that'd be great.
So in a 401k, the salary deferral, what the employee can put in is for 2025, it's $23,500. If you're 50 or older, you get a $7,500 catch-up contribution, which means the IRS realizes you're closer to retirement, so they want you to be able to ramp up your salary deferral or contributions to the plan. That can get you to $31,000. With that, the employer can do what's called a safe harbor contribution, which is, like I mentioned, the dollar for dollar match up to 3 or the 2% non-elective contribution is simple. It's similar, but we recommend a dollar for dollar match up to 4 or a 3% non-elective contribution. Safe harbor is another story. We don't need to dig into that. But the profit sharing, which I believe Jeb mentioned earlier, allows the employer to put in money on behalf of the employees and the owners if they'd like. That can get a person, if the numbers work, because it has to pass testing, because the IRS and Department of Labor don't want to be upset at you, that can get anybody who's under 50 up to 70,000 with those buckets all added up, and then anybody 50 or older can get to $77,500. So, wow. So the main difference with a simple, in my opinion, and a 401k is the contribution limits. The other kind of ancillary addition to that is you can have a lot more restrictive, you can have more restrictive eligibility requirements in a 401k. You can have vesting in a 401k where that profit sharing can take up to 6 years for an employee to be vested, which is kind of golden handcuff idea where it encourages those employees to stay. And then I think kind of the last thing that I mentioned is, and this is maybe a little bit of a soft benefit, but a lot of people don't know what a simple is. If you tell a prospective employee, hey, we have a simple, they might be like, I don't know what that is. But everybody knows a 401k is a nice benefit, and it's touted all the time. So I think that's kind of the summary, kind of the comparison between those, Ethan.
Yep.
Nice.
I've always felt that the retirement plans for a business are a little bit more of a certain levels, right? You got the self-employed, that'd be a good option for a SEP. You got a little, kind of a startup plan. You want to keep the lower cost, lower IRS filings. You go with the simple, and then you get a little bit more complex, a little bit more contribution limits, and you go to the 401k.
Yep.
And then there's other avenue, which is called a cash balance plan. And I
Yep.
know that a lot of things have changed recently with a cash balance plan that make them more attractive than they were, say, a handful of years ago. I was wondering if you could maybe touch on kind of what a cash balance plan is, how it works with the 401k and so on.
Absolutely. Great question. I kind of would say that a cash balance plan being added to a 401k. So a 401k is a 401k and a profit sharing plan together. So I'll just call it a 401k. When you have a 401k and you add a cash balance to it, I kind of say you kind of bolt it onto the 401k because they work in conjunction. You're kind of supercharging your retirement because you're not only getting the 70,000 or the 77,500 in the 401k profit sharing plan, but the cash balance plan is a defined benefit plan. And kind of like you mentioned, Eric, the defined benefit plan, the defined benefit plans used to be the old-fashioned pension plans that have really gone away because employers don't want the liability of having to pay for somebody's retirement until they pass away. Back when these were popular, people didn't live to be 100 plus. And so they've kind of gone away. But this type of defined benefit plan is still employer contributions only, but it kind of has a 401k type feel to it. But it allows people to contribute much more. And I'm talking if somebody's in their 60s, they might be able to contribute 200,000, 250,000 more, and it's all in tax deferred status, similar to a 401k plan. So it's not something that somebody who's making a lower amount of income would want to do because, first of all, they're not going to be able to take advantage of the amount you can save, but they're also more expensive. We actually we partner with a firm out of Chicago that does a phenomenal job, and all they do is cash balance because it requires an actuary. They've got, I think, 70 actuaries on staff now. We don't have any actuaries on staff. We stay on our lane and do 401ks, but I completely agree with you. It's a great thing to consider if somebody's making high six, into the seven-figure level income. It is pretty amazing, and what they've done to improve these is great. We're doing them quite a bit with our firm out of Chicago.
So small clarification on that piece.
Yeah.
So hypothetically, you've got a 401k and a cash balance plan
Right.
side by side. Let's say the business owner's putting $200,000 a year in their cash balance plan. Can they still, and let's say they're above 50, they can still get about $77,000 into their 401k plan.
Yes.
Right alongside that $200,000 contribution.
So put together, you're really, yeah, exactly. You're really jumping that up because the 401k and profit sharing plan is going to be the same. Now the caveat is the firm out of Chicago that we partner with, who's called October 3, they do a phenomenal job. They run the illustrations, the calculations to make sure it works correctly with the 401k profit sharing because these are two separate legal entities, these trusts, the defined contribution 401k and the defined benefit cash balance. The testing has to work where the amount going into the cash balance, which is really where the business owner can maximize their contributions into retirement, it has to work in conjunction with the profit sharing part of the 401k. It gets very complicated. That's why you have to have an actuary do the numbers for the cash balance. But that's correct. It's not one or the other. It's together, both of them. So
that's pretty amazing.
Yeah, it is.
Well, I'll tell you too. So I know when we work with business owners, I feel like there's two purposes for them doing a retirement plan. One is they want to stock away money, right? They want to have this big nest egg for themselves and for their employees. But the other one's the tax benefits. And so, and I know no matter what client it is that we're talking to, taxes are always kind of front and center.
Yep.
And being able to put money away. And I feel like the tax benefits of these things have changed now with Roth options being more common than they used to be, as well as you've got, like Ethan was just talking about, just massive amounts of money. If you have two plans that you can stock away in a tax deferred manner. So let's talk a little bit about the tax credits and tax benefits. I know we had Secure Act 2.0. You've got pre-tax, post-tax contributions. So let's hit on that.
Yeah, absolutely. So the Secure 2.0 Act that passed at the end of 2022 had 92 different provisions that changed retirement plans. And I'm just going to be honest, as somebody who works for a firm that we comb through that top to bottom, back to front, because we have to be on top of it. I will say most of them are kind of throwaway. I mean, a lot of these things we're probably never going to see 401ks incorporate. The thing that just jumped out where I, as the director of business development, thinking, oh, wow, this is huge, is these tax credits being offered. The IRS, with the original Secure Act, was offering some tax credits for businesses to encourage them to set up plans. And these aren't tax deductions. These are tax credits. This is better. It's dollar for dollar offsets on their taxes. Secure 2.0 really just turbocharged that, and they've got really 3 different tax credits for businesses that have never had a 401k before, never had a simple or a SEP. Now, there's still some of these benefits if you've already had a simple or a SEP, but if you've never had a plan at all and you're setting up a 401k, and especially if you're setting up a 401k and you have a number of employees, they're pretty rich. So let me kind of walk through the 3. The first is called the administrative expense tax credit, and this is for businesses under 50 employees, which most businesses setting up a 401k are under 50. I mean, it's really rare that a business is hundreds of people and they finally set up a 401k. But if a business is under 50 employees, they get a tax credit of $250 per non-highly compensated employee to a maximum of $5,000 for 3 years. So let me first of all say what a non-highly compensated employee is. The IRS breaks every plan into a highly compensated employee and a non-highly. A highly is an owner, a direct family relative, a relative of an owner who's working in the business, or somebody who earned more than $155,000 last year for this year would be considered a highly comped employee. Everybody else is non-highly. So that up to $5,000 is a 3-year tax credit that literally can make the plan free for 3 years. The second one is called the employer contributions tax credit, which basically says anybody who earned less than $100,000 the previous year, if the employer contributes $1,000 or more on their behalf from the employer, they can get a dollar for dollar tax credit for that $1,000 for the first 2 years for every employee who made less than $100,000 that they do that for. So if the business has 10 non-highlies, 10 staff, and the business gives them $1,000 or more, they're going to get a $10,000 tax credit for years 1 and 2, and that trails off for year 3, 4, and 5, 75% in year 3, 50% in year 4, and 25% in year 5. So it's a $10,000 tax credit years 1 and 2, $7,500, $5,000, and $2,500. That's on top of the first one I mentioned. So those are layered. The third one is a simple one. It's if you set up what's called an automatic enrollment on a 401k, which is something the IRS loves. It basically says if you become eligible in a plan and you as an employee don't opt to get in the plan or opt not to get in the plan, if you do nothing, you're going to be swept into the plan because it's to your benefit and it's good for everybody. But if you set that feature up, you get a $500 tax credit for 3 years. So if you add those 3 together, I mean, what I say, just if I put it in a nutshell, if you've been thinking about setting up a plan and you're kind of on the fence, the IRS is literally making the plan potentially inexpensive or free for 3 to 5 years. So why not do it now? Because the IRS has never paid you to set up a plan before.
That's right. Well, why weren't these credits available when we set up our 401k?
Good point. Exactly.
That. So, but that's awesome.
Yeah.
Well, I know too. I guess lastly, maybe just we can hit a little bit on Roth contributions and maybe some misconceptions there. And we run into this all the time. Like we'll have a client in and we're like, hey, you should do your Roth 401k. And they're like, well, I make too much money to do that. And we're like, no, you don't. And I think there's a misconception out there that the income limitations are the same on a Roth IRA as they are on a Roth 401k. But I think that's an amazing benefit now is that somebody that's not been able to do a Roth for years and years can now not only do Roth, but put $23,000 or more into one every single year.
Yeah, that's great. So, and just to let everybody know, for 2025, the maximum that a single person can put into a Roth, or the maximum income that a person can make and still contribute to a Roth, just a Roth IRA, is $161,000. If you make $161,000 or more, you can't even contribute to a Roth at all. If you're married, the maximum is $240,000. So if your income is over those two, you might think a Roth is no-go. Well, that's not true. As Jeb mentioned, in a 401k plan, the $23,500 max or if you're 50 or older, $31,000 max that you can do in salary deferral where you contribute to the plan can be all Roth if you want. It can be partially Roth. We've got plenty of employees at businesses and plans that we administer who do 50% in traditional 401k contribution and 50% in Roth. But that's a great point. You can still do your $23,500 or $31,000 into Roth, and it's kind of a way to skirt that negative to making good money. I mean, I know these people, nobody's complaining about making good money, but it is kind of a bummer that they can't put money into just a traditional, like a Roth IRA. So this is a great way around that. That's a good point.
It is cool. I'll tell you too, when we build out financial plans for clients, you'd be surprised. Like, I think a lot of people have the conception, and we don't need to go down, this can of worms, but that they have the conception that if they're in a higher tax bracket and they're younger, it's better to do tax deferred than Roth. And we run that because we use eMoney as our financial planning software, and we run plans all the time to see which one of those is more beneficial. And you'd be surprised that people that are in a very high tax bracket, that the plan will still say to do a Roth 401k, specifically when they're younger, right? Because their money has so much more time to grow, and it grows tax free. It lowers their required minimum distributions down the road, and then I guess the icing on the cake is that it passes tax free versus passing as a traditional IRA that has stipulations as to how quickly you've got to take the money out and you pay taxes on it. So I just love the fact that Roth 401ks are a thing now, and that they're very widespread, and we're doing the best we can to educate as many people on that as possible. So
can I chime in? Two other things I say about the Roth is that people will say, "Oh, well, I'm going to be in a much lower tax bracket when I retire," and I would say, "Well, time out. Depends on how much you take out from your retirement accounts, because if you take out $500,000 in a given year, your tax, and it's just traditional, your tax is that you just earned $500,000. So don't assume your tax level is going to be lower when you retire. But I think the key to a Roth for anybody of any age is its tax diversification. So the way I look at it is I put money in Roth and traditional over the years. And when I retire, what that means is if I know I want to take out a certain amount of money, I can take out in taxable money up to the point of the next tax bracket. And then above that, I can take out tax-free money from my Roth. So now, we all know that it's a graduated tax structure. So it's not like if I'm taxed at a certain level, it's not for everything. It grades up. So why not hit that? If I know that this is the dollar amount where my tax jumps up, then I can do Roth above that. So it's tax diversification as well.
Yeah. Gives you a lot of flexibility in retirement.
Yep.
So
exactly.
I know we're running running up on our time here. So this has been a great show, and Casey, thank you for coming on. Thank you to EIP and to Corey and all of you guys for being such a great partner over the years. And hopefully we'll have you on here again someday. So
absolutely, and thank you for your partnership. You guys have been great at Metcalf Partners. You've done a great job with us, and we really appreciate the partnership.
That's great. So, well, thank you. And this is Metcalf Money Moment podcast, and we are signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.